Why sustainability reporting has become essential? This is the question. That why we have to think that sustainability and governance and risk. This is not our area. This is someone else's area. No, it is wrong. This is very important. Why? Because all the investors are demanding this, that how you are sustainable, how is your sustainability reporting, what you are reporting. Luckily, as you know, that I have worked as director of finance as well in Pakistan for 5 years, and I got the honor to submit the first sustainability report of ICMAP back in I think in 2015. No, back in 2015-16. I don't remember exactly the year, but I was the person who led this, and we were the first educational organization who published this report in Pakistan, and this honor goes to us. So I know this area very well. What happens that the investors are demanding that how you are sustainable, because they want to see that are you following the environmental issues, are you tackling those issues, are you taking care of the risk. So investor demand is this forward-looking information beyond historical financials. They want to see the forward-looking. They don't want to see the historical things where decision making used to be made. Capital access is ESG performance increasingly tied to financing and investing decision, because this led the investment decisions and capital access. Regulatory pressure, because now, as Hamad explained, that current UN laws are not allowing to do business, and they are taking care it a lot, and they are pushing the governments to do these compliance. And enterprise value. Sustainability directly influence risk profile and long-term valuation. It gives a very positive impression if you are following these sustainability reporting and following these compliance. So this is very important. Then how this moves from numbers to the what makes ISSB think that this should be the part of the reporting structure. This is how they think that the CRS from the CRS, the voluntary community reports, they started thinking for ESG structure metrics across framework, then TCFD, climate focused disclosure recommendation, and then ISSB implemented S1 and S2. These all the terms will be explained by our main speaker. So I'm just quickly going through and actually warming you up for this upcoming main webinar presentation, which Mr. Yusuf is going to present. The scope and structure of the standard is we have S1 and S2. S1 generally it is taking care of general sustainability disclosure, covers all sustainability related risk and opportunities that could affect investor decision, including climate, biodiversity, water, human capital, supply chain, and cybersecurity and governance. And S2 is dealing climate related disclosure, which includes required disclosure of greenhouse gas emissions, scenario analysis, transition planning, and climate resilience. So these two standards are dealing this, which we will discuss later on, and Mr. Yusuf is going to tell all the details about this. The four pillars which IFRS 1 and IFRS 2 is based are governance, strategy, risk management, and metrics and targets. How the entity governance bodies oversee sustainability related risk and opportunity. This is the question. In Saudi Arabia, these areas are very much taken care, and good companies are really thinking about this, and they are shifting their minds from traditional thinking to the governance and the strategy and risk. Recently, I have made one regulatory audit where I checked governance and all these things, and this was very well welcomed by Capital Money Authority and the company itself, and the findings which I made about the governance, they have implemented it properly. So in Saudi Arabia as well, these things are really taken care. And the strategy, how sustainability risk and opportunities affect entities' business model and strategic planning. this I will tell you that how this S1 and S2 are going to hit our other IFRS, which we are implementing in our reporting. Risk management is also there, and this also I'm going to tell you with the particular IFRS numbers that how it is going to implement and metrics, targets, performance indicator and target used to measure and manage the sustainability outcome. This I will give you a case study, and this case study will tell us that how S1 and S2 are important to have a decision and attract the investors. This is the slide I was talking about, that linking IFRS Sustainability Standard with IFRS Accounting Standard. First going concern, which is dealt in IS1, and later on it will be shipped to IFRS 18. Access material uncertainties. You have to see that if anything is related to any like compliance issues that could create problems, so it will be parked as going concern, and you have to see that if the company is facing a going concern issue or not. Then the asset impairment, we know that we do impairment of the assets while we make the reporting, and IFRS 36 is dealt in that. So we have to revise recoverable amount. This will be covered again in the case study, which I'm going to tell soon. Environmental obligation, IS 37, recognize provisions when criteria are met. In the IS 37, we have to make provisions, and we have to make provision accordingly if any environmental obligation we have to manage, we have to take care. Financial risk, IFRS 7, enhanced risk disclosure. Similarly, expected credit loss, IFRS 9. If any environmental issues creating your expected loss, so you have to deal, and you have to implement it in IFRS 9. Fair value, IFRS 13. Leases, IFRS 16. And segment reporting, IFRS 8. And subsequent event, IAS 10. If anything happened after reporting, subsequent event you have to deal, and you have to take care if any climate change or any risk area is concerned. This is a case study, small case study, that there is a company, Green Steel Manufacturing Limited, and it is a steel manufacturing operations are 3 manufacturing plants. This is export-oriented business, high energy consumption, and coal-fired productions process are used to manufacture. Climate-related challenges are introduction of carbon taxes, rising electricity prices, pressure from customer to reduce emission, banks requiring ESG information before approving financing. Now, banks are also very much concerned if they are giving you a loan. They ask these questions, and it increase or decrease your credit worth if you are following these S1 and S2 reporting standard. Management response. Is invested currency units 350 million in energy efficient technology, install solar power systems, implemented supplier sustainability assessment, set a target to reduce emission by 40% by 2032, and integrated climate risk into enterprise risk management. What happened that financial reporting impact, property, plant and equipment, IS 16 is affected because you have to capitalize the new energy. Impairment, tested the old coal-based asset. If it is really outdated, you have to impair it, and this will hit your bottom line. Provisions, recognize environmental obligation where required. Fair value, updated assumption affecting valuation under IFRS 13, and sustainability report, which we are already discussing, that you have to see S1 and S2 standard accordingly. So this is one practical example, and you can apply it in your particular industry, your work, that how it is impacting and how it is really doing this. Financial statement and sustainability disclosure should tell one consistent story. It should not tell the different dynamics. Otherwise, you have to adjust it in the numbers and make your reports accordingly. IFRS 1 and IFRS 2 are not about producing another report. They are about improving business decisions. This is the roadmap of IFRS 1 and IFRS 2. Obtain board commitment, then conduct a gap assessment, identify material sustainability risk and opportunities, strengthen governance and internal control, build reliable data collection system, perform climate scenario analysis, prepare integrated sustainability disclosure, and finally continuously monitor, review and improve. and they are the challenges. You can read it if while you are implementing these in your report. Their journal, you can read it. I just want to waste time. The five messages, important key messages. Sustainability report is now a strategic financial responsibility. IFRS, just a second. IFRS S1 establishes the general provision for sustainability related financial disclosures. IFRS S2 focus on specifically on climate related risk and opportunities. Sustainability assumption should be consistent with financial reporting under IFRS accounting standard. Organization that integrated sustainability into strategy and decision making are better positioned for long term value creation. Sustainability reporting is not about predicting a future, it's about demonstrating how prepared your organization is for it. That's all about me. Before I wind up and hand over mic to Mr. Mohammad Yusuf, I would like to share another slide which I would like to tell you about my upcoming course, IFRS training. Just a second. Recently, I'm going to have a course, a complete course. If you want to learn about IFRS, this course is going to happen in Karachi, Lahore, and Islamabad. At the moment, I'm in Pakistan. It will be a physical course. So, if you are interested, you just contact me because I'm going to have this course. Those of you who are really missing IFRS and who want to be updated from all of IFRS, this is the certification in IFRS. So this is just a small announcement.